Hi everyone, so today we're going to be doing a new video called Autodesk. So let's get right into it. It's going to be a stock analysis video. Alright, so looking at this company a little bit further, they make 3D designs, engineering, and entertainment software like the famous AutoCAD used by professionals in architecture, manufacturing, construction, media, and gaming to design, visualize, and simulate ideas from buildings to cars to blockbuster movies, visual effects. Google just has a kind of like a basic software explanation of the 21 plus different products or apps that they have on their website. So it does look kind of cool, but I think it's pretty self-explanatory in general. So yeah, they're just pretty much a software company to just make it super simple for everyone to understand, to just get to the point of what industry they're in. Now, when we look more importantly, I think, in my opinion, at the earnings report, the earnings were okay, I would say, for now. So we have that they beat for EPS, they beat on revenue. So company reported non-GAAP earnings at $2.67 per share and $1.85 billion in revenue, representing an 18% year-over-year increase. So really good on that. Non-GAAP EPS was an increase of 23%, good. 18% total net revenue, good, and free cash flow surge 116% year over year to $430 million. It's really good on that. They did very well on all that. But just to put this in perspective now, they're projecting for the full year 2026. Keep in mind this is for Q3 of 2026. They're technically a year ahead. But for the full year 2026, they're projecting approximately 12% in revenue growth. So it is not going to be a substantial amount of growing. Still, this company is a little bit more mature. It has a significantly bigger market cap. And we're going to see that in a second in Simply Wall Street. So when we go ahead and we see Simply Wall Street's going to say that, well, currently they have a $63.7 billion market cap. But right now they're at $2 billion free cash flow. The next 3 years they're going to be at $2.9 billion. So they're not doubling. They're certainly slowing down. I would say in general, don't get your hopes up high. This is not a growth stock. If anything, this would be like a value stock, to be quite honest with you. The financial health of the company, let me pull that out for a second. It has recovered significantly since 2019, 2020, when they had negative equity, so negative shareholders' equity. So I think now it's a little bit better. There's not too much to complain about. Obviously, they have a high debt load. And the cash isn't exceeding that, so you have to be a little bit cautious about the high debt load that they're tacking on here, just for everyone to be fully aware. Now, when we look at my DCF is going to say that it is still overvalued by about 5% on historical growth. When we check Wall Street forecast, Wall Street's going to say it's 21% overvalued, so I would go by historical growth because you're growing 12-13% year over year on just full year 2026. Its revenue growth is 12%, so historical is more accurate. So it is overvalued by, I would say, like 5-6%. And Tipranks, however, is actually going to disagree with me. Tipranks is going to say that this is a strong buy. 19 buys, 4 holds, 25% upside on the stock. I don't agree. I think this is pretty overvalued right now. In general, so you do have to be a little bit cautious of it. I think it's a good company, and I think there's some value to be extracted here, but I would probably wait for a little bit of a sell-off and then possibly buy some shares. All right, everyone. Thank you. I appreciate it.